Look at this stock. 30% revenue growth in Q1 FY27, hitting 6,828 million rupees. Its oncology business is exploding, and its rare disease segment just surged 35-fold. Sounds like an absolute winner, right? Well, hold on. While the top line is booming, EBITDA margins dropped to 6.3%, net profits dropped by 32%, and the stock is trading at a massive 110 times PE ratio. Today, we're putting AstraZeneca Pharma India through a rigorous 10-point worst-case stress test. Is this high-flying MNC pharma stock a multi-bagger compounder or a valuation trap waiting for a crash? Let's find out. Baseline performance and Q1 reality check. Let's look at the baseline numbers from the latest quarterly report. Top-line growth. Revenue from operations jumped 29.7% year-over-year to 6,828 million rupees. Therapeutic drivers? Oncology leads the pack with 4,649 million rupees, accounting for 68% of total sales. CVRM and respiratory added 1,619 million rupees. Gross margins held at 55.1%. So where's the catch? Look at the bottom line. Despite record sales, net profit fell approximately 32% year-over-year to 379.3 million rupees, pushing EPS down to 15.17 rupees. Why? Higher costs for imported stock in trade from the global parent and heavy commercial investments for new launches. Under a normal scenario, assuming modest margin recovery next quarter, we project revenue 7,067 million rupees, EBITDA margin 8.5%, projected EPS 20 rupees and 60 piece. That puts the stock at a normal fair value of approximately 7,416 rupees, right near its current price of approximately 7,500 rupees. But what happens when things go wrong? The 10-point MNC stress test. We applied a customized 10-point systemic stress test to see how resilient AstraZeneca India really is under a worst-case scenario. 1. Price controls. NLEM expansion. A 20% price cap on key oncology drugs cuts gross margins by 450 basis points, wiping out 307 million rupees in EBITDA. 2. Supply chain bottlenecks. A 10% revenue hit from import stockouts losses, 125 million rupees in operating profit. 3. Generic competition. Loss of exclusivity on key molecules causes immediate market share loss to domestic generic competitors. 4. Parent royalty hikes. A 150 basis point increase in technology transfer fees squeezes local margins by 102 million rupees. 5. Regulatory delays. DCG. I approval delays defer 350 million rupees in high-margin new product launches. 6. Institutional price squeeze. Defense and government tender pressures shave 120 basis points off gross margins. 7. Forex depreciation. INR weakness inflates formulation import costs by 5%. 8. UCPMP marketing rules. Tighter compliance adds 50 million rupees in fixed overheads. 9. Batch. Recalls. Localized voluntary recalls add 100 million rupees in inventory write-offs. 10. Multiple derating. Investor sentiment shifts, compressing the forward PE from 110 times down to an industry average 45 times. Price discovery and valuation. Verdict. Under this synchronized downside scenario, quarterly revenue drops to 5,750 million rupees. EBITDA margin shrinks to a razor-thin 4.0%. Quarterly EPS drops to just 6 rupees and 60 paise. Annualized 26 rupees and 40 paise. At approximately 7,500 rupees, the stock trades at 110 times earnings, leaving zero margin of safety. If severe operational shocks hit, the stock's discovered fair value falls dramatically toward 1,150 rupees. To be fair, management isn't sitting idle. On their latest call, key highlights included pipeline momentum, new DCGI, approvals for acalabrutinib in leukemia, and trastuzumab deruxtecan in HER2, positive breast cancer, diagnostic tech, AI lung screening partnership with Telangana State using Kure.ai. Long-term target, delivering double-digit top-line growth and expanding specialty therapy access. The bottom line, AstraZeneca Pharma India is a top-tier science business, But at a 110 times PE multiple, the market is pricing in absolute perfection. Any regulatory or margin hiccup could trigger a sharp valuation reset. What's your take? Is the premium price tag justified by their pipeline, or would you wait for a margin correction? Drop your thoughts in the comments below. Hit like and subscribe for more institutional grade equity analysis. See you in the next video.